Here's what's been happening lately. 3 things. First, Mayor Brandon Johnson devises a strategy to tackle the pension crisis that includes deferred retirement options. Next, climate change is fueling a surge in Illinois home insurance premiums. And lastly, Mayor Brandon Johnson defends his proposal to give the area around the United Center a $55 million tax break. Let's break it all down. First, Chicago is crafting a plan to chip away at its $35.8 billion pension crisis that is likely to offer city employees the option of buying out a portion of their future pension benefits in exchange for a lump sum payment up front. Acting Chief Financial Officer Steve Mahr said last Thursday that he expects the so-called D.R.O.P, D.R.O.P, or deferred retirement option to be one of roughly a dozen or more ideas that will set the city's agenda for the next decade. The Pension Commission that Mayor Brandon Johnson created shortly after taking office disbanded without releasing a single report after Governor J.B. Pritzker signed a police pension sweetener that over time will make Chicago's pension crisis $11 billion worse. Now, the Johnson administration has asked Ernst & Young, the consulting firm that recommended $1.4 billion in savings and revenue generation options for the city, to consider to start climbing the mountain of unfunded pension debt. Deferred retirement options already are offered at the state level and in municipal pension funds across the country. It can be made available to Chicago's 33,432 employees, but only if state lawmakers agree to authorize it. A bill sponsored by State Senator Robert Martwick of Chicago would do just that, and earlier this month advanced out of a Senate committee. Those types of payouts are now allowed for state retirees, and Martwick said it has reduced Illinois' pension obligations by approximately $2 billion. Next, Illinois home insurance premiums are going up, and climate change-powered severe weather is in part to blame. Average U.S. home insurance rates climbed 12% last year and are projected to surge another 4% in 2026. Illinois is expected to top the national average with a 5% increase, leaving policyholders statewide paying an average $3,559 in premiums per year. Between 2021 and 2024, home insurance costs increased by about 50% in Illinois, costing homeowners close to an additional $1,000 per year, according to a Consumer Federation of America report. In the same time period, only Utah experienced a higher rate jump. There are a lot of factors behind rising insurance bills. Companies consider the value of a home, the cost of the materials needed to rebuild it, and even the credit scores of the homeowners. But according to Insurify's Matt Brennan, one of the primary culprits is the rising toll of extreme weather as the planet warms. Developers are also building homes in flood-prone areas, adding to rising premiums. Insured losses from natural catastrophes in the U.S. averaged $100 billion a year between 2023 and 2025, up from an annual average of around $15 billion per year a decade earlier, according to the Insurance Information Institute. State Farm, the largest home insurer in the country, announced plans to raise homeowner insurance rates by more than 27% across the state last summer. Not far behind, Allstate, the nation's second largest home insurer, filed for increases totaling almost 9% on average for more than 200,000 Illinois policyholders. Both Illinois-based insurance giants pointed to extreme weather as driving up costs. In 2024, only Texas reported more hail damage than Illinois, according to State Farm. Lastly, Mayor Brandon Johnson last Tuesday defended his support for a $55 million property tax break that would help the owners of the Chicago Bulls and Blackhawks redevelop the parking lots around the West Side's United Center into an entertainment district and new neighborhood. The $7 billion real estate development, known as the 1901 project, would transform the surface parking lots that surround the home of the Bulls and Blackhawks with a 6,000-seat music hall, 233-room hotel, public parks, and as many as 9,463 residential units. Johnson said the project will bring economic vibrancy to the west side of Chicago. With the support of 27th Ward Alderman Walter Red Burnett, Johnson asked the City Council to make the project eligible for $54.7 million in property tax incentives under Cook County's Class 7B special assessment. Commercial properties in Cook County are typically taxed based on officials' calculation of 25% of their value, records show. The incentive backed by Johnson would allow the surface parking lots around the United Center, set to be redeveloped during the project's $500 million first phase, to be assessed at 10% of its value when Cook County officials calculate the owner's tax bill for the first 10 years. 15% in year 11 and 20% in year 12. The incentive, which is designed to make projects possible that would not otherwise be economically feasible in areas that sorely need economic development, could be renewed before it expires. Rather than providing a direct subsidy to redevelopment efforts, the tax incentive program is designed to help large projects get off the ground by earmarking a portion of the new property tax revenue generated by the project. Estimates from the city's Department of Planning expect the first phase of the project to boost property tax revenue by $46.3 million while creating nearly 2,000 construction jobs, 600 permanent jobs, and 180 part-time positions.